So what are you expecting from the ECB?
Well, our forecast is 20 basis points and a tiering on the deposit facility and reactivation of quantitative easing. So 30 billion at the bare minimum. So
quite a full section of action there. And what about the fact that it's Mario Draghi's final meeting and whether or not that means just indicate that this could come rather than actually pull the trigger on the action? Well, I think that's an important element of what we're forecasting. We think, the ECB needs to send a strong message. Obviously, there's a lot of speculation about the lower bound. Negative rates have done all they can. But if they want to kind of reinforce the prospects of being able to do more while implementing a tiering on the deposit facility, they have to be more aggressive because that's your number one message to the markets. We've gone more aggressively than you expected. Therefore, we're not worried about the lower bound and we can do more if required. And that's going to have a much bigger market impact than being more cautious, doing the 10 basis points that's fully priced. And I think that would just lead us to disappointment.
As we continue to watch the Brexit headlines, what's your forecast for what we're going to see here in coming days and weeks and how that plays into the currency market, particularly for the pound?
Well, at MUFG, we have a 60% probability of no deal. So that's definitely higher than the markets. We've got a cable forecast. We've got to shift that out a little bit because it's now possibly extending into 2020. But cable forecast of 110. We think essentially the number one strategy of Boris Johnson is a general election. The population in the UK have become sick and tired of Brexit. And I think they're seeing the polls that suggest exactly that. And that's why he's being so aggressive and so forceful. So
Derek, you're saying 110 on the pound, considerably lower than where we are now. You're also saying that the ECB is going to loosen more than perhaps the market expects. So dollar goes where from here?
Yeah, I think short term, dollar's going to strengthen. So we've got 107, 108 on euro, on cable, as I've said. So for President Trump, he's not going to be happy. And the whole idea of intervention could very well come back into the markets. And, what about a no-deal Brexit in January 31st and Trump coming in and intervening in the markets? He would do it independently, but it would be a perfect opportunity. And on the G20 platform, you are allowed when you're in disorderly financial markets. And that's exactly what would be the case after no-deal Brexit.
And next week, Federal Reserve, if they do as expected, a quarter-point cut, that doesn't really move the needle in either direction?
It doesn't really. No. And again, the criticism of President Trump of the Fed is just reinforcing the perceptions of a Fed that is ultimately pretty cautious. And a 25 basis point move next week would be consistent with that as well.
Quick final thought, Derek. That ECB action that you're expecting, does it save the outlook in the next 12 months for the Eurozone economy, or is it not enough?
It's not enough. Again, another reason why we think they should go more aggressive on negative rates. They need to force governments to reconsider their inconsistent, inappropriate fiscal policy. When you have negative rates like you do in Germany, and then to be running a budget surplus of 1.7% of GDP, it's crazy, and that needs to change. And deeper negative rates could put more and more pressure on the policy dynamic changing from central banks to governments. And that's perhaps what will happen under Christine Lagarde.